So that brings us to the third segment, insurance platforms. For once, a segment where you can say the general conditions are stable. Overall, the insurance business is something that grows more or less in line with the rate of inflation in Germany, depending, so to speak, on whether there are government incentives or not, sometimes slightly above or below the rate of inflation. But overall, a stable market environment. With our three platforms, we address the three most important submarkets of the insurance business. Firstly, the core private customer business with the standard insurable policies through Smart Insure. We address occupational pension products, especially retirement provision via the employer with ePension. And in future, we will also help to process industrial insurance in Germany, where highly individual risks are tendered and insured in a more structured and digital way with Corify. All three platforms have developed positively. You can see this in the key figures of the three platforms. So with Smart Insure and right, Jan, I need your feedback again.
You're back again. Your mouse was visible the whole time, but you disappeared briefly with a video.
Okay, clicking wasn't working here either, but now, so I was just about to transition. The platforms have experienced positive development, but nevertheless, the sales supporting and service supporting units had to record declines in 2025. There were a variety of smaller issues. Overall, this means that the gross profit and EBIT of the segment are slightly below our expectations. So we've remained stable in terms of gross profit. As I said, a positive shift towards the platform, that's fine as well. EBIT ended up neutral. We had hoped for a bit more, but we can also see that thanks to the platform's growth, we've now laid the foundation for things to move forward in 2026. And we'll see a positive performance, both in terms of gross profit and EBIT in the segment. So that means we've now covered all three segments overall. You know the details for the year 2025. Now let's take another look at the group as a whole. Those are the key features again from the beginning. Double-digit growth, clear outperformance on the earnings side. As mentioned, gross profit, a new record, EBITDA, the fourth best year. So there's still room for improvement. Historical context. In a long-term comparison, you can see that quite clearly. We look back on a turbulent development since, in effect, 2021. We're now returning to our former strength, you could say. We currently see this as a period in which we are growing in quality, in which we have sifted through many of the ideas we had up until 2022, continuing those that promise success, some of which have already been brought to fruition or are on the verge of doing so. And the business models that have always been successful are now significantly improving their resilience to market changes, improving, and of course, so are we. We are making use of our market position to expand our value creation and thus our high returns in the respective products through additional innovations. All in all then, a successful year for Hypoport and a solid foundation for the year 2026. So that's what we're looking towards now. Okay, now it's clicked on, so I suppose I'm back again. Jan, give me a thumbs up, please.
Yes, you were gone for 3 seconds.
Come on. So, of course, we can't avoid taking a look at the market as well. So, a primary market, home ownership. We are finding that the supply of residential properties is high, and we expect it to remain at this level. We do not expect to see a flood of rental flats coming onto the market at the same time. And from other sources as well, it is not to be expected that there will be a high number of properties. As I said, new builds will continue to decline. But we also do not expect there to be significantly fewer properties because, of course, the efficiency of the markets and price discovery ensure that properties have a certain marketing period. And in this respect, this will have a stabilizing effect on the market as a whole in all directions. As for the supply of rental flats, we're certain that it will at least remain at this low level. To be fair, turnover rates will continue to decrease, especially in medium-sized towns. In the big cities, we're already seeing hardly any turnover at all. People are holding on to their rental flats. This will lead to there being less supply. More and more properties are, if you like, being marketed informally. They're no longer visible at all. You have to happen to know the landlord privately in order to have a chance of getting a property. Because regulation also makes it unattractive for landlords to expose themselves to the public market at all. So, tough times for tenants and at the same time also for those who can afford to buy property. It's a clear indication that the only place they can still find a suitable property is on the owner-occupier market. What effect will this have on prices? We'll continue to see rising prices for existing properties. Not as dynamic as we saw up to 2022 though, so growth rates are 10%. On the national average, I would rule that out, at least assuming relatively stable interest rates. Instead, I would expect growth rates for prices to be slightly above the rate of inflation. So for this year, something below an inflation assumption of 2%, more like 3 to 5%. Property price development, because more and more people are effectively being pushed out of the rental market and are looking for an outlet here. Construction prices, despite much political talk about measures against rising building costs, continue to show a clearly positive trend. And we will continue to see this in the coming years. Politicians currently do not understand that with every further regulation, however well-intentioned, they continue to drive up construction prices. And therefore, that we will see any relief in the housing market, either through a greater number of completed units or through cheaper construction, is something I can roll out based on my observations over the past 15 years and the political actions in this area. And as such, the prices for new builds are rising. So anyone who wants a new build because they can't find what they want in existing properties really can't start building soon enough, to put it plainly. It will continue to get more expensive. And that's even before the turbulence we're currently seeing geopolitically. So, against this backdrop, we naturally also assume that due to rising prices and a shift from the rental housing market towards the owner-occupied housing market, we will then also see positive impulses for our market volume. That is, for what needs to be financed in the market. We're still at a historically low level there. So you could say that in 2025, the recovery only continued up to the first quarter, following the crisis in 2023. We are now operating at a level, if you like, inflation adjusted, a level in the mortgage market that corresponds to the period around 2012, 2013. It's important to know that back then, there was hardly any net migration to Germany. We had extremely low property prices, roughly half of what they are today in Germany. So that means if you adjust for prices, the activity in the property market is only about 60 to 70% of what it was back then. And that is, well, that's weak. There's no other way to put it. It's low. The dynamic we've seen up until 2022 is an adjustment of German price levels to those of other European countries, triggered by the freedom of movement for workers and due to greater European integration. And we can see that this trend is continuing. Today, our prices are quite normal by European standards, but the number of units is far too low. And ultimately, of course, the rate of home ownership is also much too low. We can see that the frozen rental market will lead to the frozen ownership rate in Germany slowly adjusting to the European level. So we will see a rising rate of home ownership in Germany, which in turn will feed a growing market. In addition, of course, there will be increasing refinancing volumes in Germany, starting from 2027 and continuing onwards. The red curve, that's how Europace has developed over the last 6 or 7 years. The grey-black curve, those are the Bundesbank figures, as mentioned, including all possible markets that cannot be addressed. We assume that if you were to exclude the non-addressable markets, the curves would have developed even more dynamically in favour of Europace. We assume that this trend will continue because the efficiency gains achieved through Europace's transformation in the industry are significant. Especially in bank branches, these gains are becoming increasingly decisive in market competition. And now, on top of that, there is the added pressure from AI and the generative models that engage and retain consumers more effectively. And with that, the entire way in which brokers, but also banks, interact with the world and with consumers will change. This brings us to an important keyword, which we have been asked about frequently of late. AI is nothing new to us. We ourselves have been engaging with it intensively for some time now, you could say. For 10 years, for 8 years, we have been rolling out products based on AI and have, in the meantime, integrated a large number of algorithms into our platforms. Here are a few examples for the European platform, what is already live there, and how it is supporting the work of advisors and credit decision makers. And in part, how it is already simplifying and automating things for consumers as well. The world of the future, in which agents assist the consumer, supporting them in successfully handling their property financing, whether through generative models or specialized AI models for this purpose, will lead to changes in the value chain. So, generative AI, that is, all agents will position themselves between the consumer and today's intermediaries. You could say, similar to what Google has already done in the past, and ensured that a portion of the overall value creation through corresponding revenues also remains at this stage of the value chain. We are certain that through the central product integration, we can achieve this. One could say for the entire German market, and uniquely at this level of quality for the 800 banks, we are the right technical point of connection for all AI. They're out there. We have built for an open architecture. We have APIs for all the important services needed in the process. We can also make these available on MCP for any model that wants to have it. And in this way, we can provide the complete knowledge about the German mortgage offering and the ability to complete transactions to any model out there. What we do not see is that models penetrate all the way to the bank's product offerings, because that is not digital enough. So the typical German bank does not have a digital representation of its product. The only digital representation is Europraise. But it's not just the one bank, but many others as well. So the idea that generative AI or even specialized AI laboriously digitizes bank loan products in order to make them directly available to consumers is hard for me to imagine, given the complexity we see in reality. And of course, the regulations also play a part in ensuring that it's not so straightforward. What we also don't see is that generative AI models are completely replacing the intermediaries. A, it's a regulated function, at least in the German market. B, it's a question of liability because someone has to take responsibility to ensure that the consumer has been properly advised. And in this respect, we rather see a further symbiosis between the one who digitally maintains customer contact, in the past, Google, in the future, AI, and the intermediary who ultimately discusses the legal, regulated advisory decision with a customer and ensures that a resolution is reached. Of course, all of this can also be done digitally. The subtle nuances, as we see, for example, with Apply and Demonstrate, make it clear that, of course, intermediaries will also integrate AI. In part, Europace will make this available to everyone, but there will also be specialized models from individual sales organizations tailored to their sales processes, their target groups, their types of property, and specifically addressing certain niches in the market. So here we see a diverse increase in efficiency throughout the entire value chain through the use of AI. And we, so to speak, Hypoport with Europace with Dr. S. Klein will actively shape this process and further improve the quality of our services for everyone. With a high speed of software development, we're already making extensive use of AI today, and we ensure that we provide better software more quickly. But in the end, it is especially the consumers who will benefit from this through lower prices, greater reliability, and faster processes. And as a result, we also hope to see a significant boost in the rate of home ownership in Germany because we are making it possible for more people to own their own four walls. So, with all that said, let's look ahead to the year 2026. From the 33 million last year, we expect that by reducing losses in the three platforms where we are still investing heavily, we will see improvements in the order of 4 to 6 million thanks to gains in market share. Through our existing offerings, through the successful business models. Of course, this is already adjusted for slightly rising costs, which we inevitably have. This will bring us another increase of 5 to 6 million. And in the end, it will be the market that decides. And there, I am primarily looking at Germany, and specifically at the property financing market, where we are seeing our results. So we are expecting EBIT to be between 40 and 55 million. The greatest uncertainty here is the market development in the year 2026. And it must also be said quite clearly that the current geopolitical upheavals are, of course, creating a great deal of uncertainty because it is difficult to foresee how long the conflict between the USA, Israel, and Iran will last, and the pressure it will put on energy markets, which in turn could potentially affect inflation and thus also the interest rate level worldwide, and therefore also in Europe. And knowing that German sellers only react very sluggishly to changes in interest rates by lowering prices, we naturally have to remain uncertain, quite simply. What slowdown? The German residential property market is being affected by these geopolitical upheavals and the risk of significantly rising interest rates, at least temporarily. In the long term, we do not expect the interest rate level in Germany to be higher. We have now had several recessionary years behind us. In fact, all economic research institutes are currently revising their growth forecast downwards for the year 2026 as well, despite the enormous additional debt that the federal government has indulged in. And against this backdrop, a high level of interest rates in the private sector is becoming increasingly difficult to imagine. And the ability of states, including the Federal Republic of Germany, to simply continue taking on more loans and squander them on electoral giveaways is diminishing. So, with this pressure, the level of interest rates will also continue to come down in the long term. We lack the economic dynamism to even be able to afford a high level of interest rates in Europe. So, when you look at Hyport, you see someone who, if we take the medium term perspective again, is operating in a fundamentally attractive market environment, a growth market. Housing is a scarce commodity. People will need it in the medium term. And this can only be solved, or at least addressed, by creating additional home ownership. All of this needs to be financed. We are highly integrative with our products, continue to drive this forward, and ensure that we gain incremental market share at every stage of the value chain. And in doing so, we also ensure corresponding growth in our revenue, outpacing the overall market development. Our models scale, our business models scale. We are still at an early stage everywhere, and there is still a great deal of potential for increasing our results when we look to the medium-term future. And in this respect, in addition to the forecast for this year, with a high yield of at least 280 million and EBIT between 40 and 55 million, we also dare to say, in the medium term, by the end of this decade, we want to double our EBIT margins again from the current level, because that is simply a realistic projection of what we are currently seeing and also of the performance of our business models. We have seen this over the past 3 years since we significantly restructured the group,